Hello and welcome to BloombergQuint. We got a note from Moody's yesterday downgrading India's sovereign rating, putting it on negative outlook as well. Well, markets didn't seem to react very much to it. Neither the equity nor the bond or currency markets showed much of a reaction. But were there warnings in that note that we should take heed of? Joining us to talk about all things markets is Neeraj Gambhir, Head of Treasury and Markets at Axis Bank, having a chance to speak with him after a while. So, Neeraj, thanks for your time here on BloombergQuint. I'll
Hi.
start with Moody's, Neeraj. Seemed like markets seem to shrug it off, not just the downgrade, which I know was widely talked about from Moody's, which was one notch higher than S&P and Fitch, but the negative rating, negative outlook, was a bit of a surprise. Still, the markets didn't seem to take much heed of it.
Yes, you're right. I think the fact that Moody's and S&P and Fitch, there was a gap of one notch, and that one notch could be corrected in this environment was kind of anticipated by the market. But we did not expect Moody's to continue to retain a negative outlook. And we thought that the outlook could be at least made, after the rating downgrade, the outlook could be made neutral. But they have chosen not to do it. They have chosen to keep it negative, and I think the reasons for that are quite understandable. The reality is that there is, all the forecasts around GDP growth that you see, including that of our own economics team, are pointing towards a fairly severe downturn in the economic activity and continued downturn. The actual forecast for the year is there is a wide range out there, but people are forecasting anywhere between -3% to -5%. So effectively, we are looking at a sort of a GDP compression. And given this backdrop, it is not surprising that the rating agency has chosen to maintain its negative outlook. And I think it's quite logical also to say that we will continue to see how the situation works out over a period of time. We know that the lockdowns are steadily getting lifted effective the start of this month, and therefore we will need to see how quickly we can come back to some sort of normalcy, and how quickly the economic activity can get started. The good thing is that we have still about 10 months to go for rest of the year. There is a long way ahead of us, and we need to see how we as an economy come back into normalcy.
The broader economy in a minute, but do you see a real risk of us losing our investment grade status? I think that would be the real disappointment, and I'm sure markets would respond to it. Foreign financing markets would respond to it as well. Do you see that as a real possibility?
I think it's hard today to say that that possibility does not exist. It is going to be a very, the bar around rating agencies for us, for them to sort of drop our rating below investment grade is going to be quite high. We all know that we are in a very unprecedented economic situation, and it is not just for us in India, but it is a global unprecedented economic situation. Countries across the world have been using a high amount of fiscal stimuli, which is going to have impact on their fiscal numbers across the board. So again, we are not alone in this. But if the situation persists, and given the fact that going into this crisis, we were actually looking at a very weak set of economic numbers, we were looking at a fairly stretched fiscal itself. And if this situation continues, and the fact that we will have again a very stretched fiscal situation, and it could take us a bit of a time to come out of the situation, could have a bearing on rating agencies and their outlook. So can I say that the rating agencies will not downgrade us below investment grade? Answer is no, but I'm hoping that the bar of doing that is fairly high, and they will be a lot more patient around how the situation pans out before they take an action.
Moody's also raised, but we've been seeing this independently as well, and one of that continues to be government finances. Again, I was a little surprised that we haven't seen much of a reaction from the debt markets either to the 12 lakh crore borrowing number or the the fact that we had fairly significant fiscal slippage even in FY20 and FY21's numbers are fairly uncertain. But yields have been more or less range bound. Is it because they had already sort of feared a worst case scenario and they're still within that?
I would say that if you look at where the overnight rates are today, where the policy rates are today. The policy repo rate is 3.5, and the overnight rate, the reverse repo rate is 3/4. Sorry, and the actual overnight rate is close to 2.50. If you look at where the market repos are trading, they're somewhere close to 2.5. Still, the 10-year bond is trading at about 575. That's the new bond. The old bond is trading close to 6%. So there is a very wide gap between where the overnight market is and where the 10-year government bond is trading. In a normal circumstance, if the market did not have this worry around fiscal, this spread should have been a lot tighter than it is today. That is point number one. Point number two is that the fact that the market is at around 6% or 5.75 in the new bond is dependent upon the fact that, or rather is driven by the fact that there is a very strong expectation in the market that eventually a large part of this supply, whether it is coming from the central government or whether it is coming from state governments, will get in some form or the other absorbed by Reserve Bank in its balance sheet. So market is expecting later or sooner some kind of intervention by RBI, either directly or indirectly, to take a significant part of the supply onto its own books. If for whatever reason that expectation was not to be, was not to turn out to be true, or there was an expectation that that may not be the case, I would see a fairly significant reaction on the other side, i.e., the yields will start going up again. So I think we need to see why markets reaction has been quite muted and probably not as wild as we had thought, is because the market believes that there is going to be support from RBI.
Two follow-up questions on actually both those parts, Neeraj, and now sort of getting into more monetary policy than anything else. So the RBI will continue to deny that, say, the TREPS rate is what they are looking at. They will still maintain that we are looking at the call money market rate. And if you just do repo to 10-year, then you're about 440 to 6, so about 160 odd basis points on the spread. That is slightly higher than normal, right? Or is that much higher than normal?
So it's not 440, it's 4%, and so reverse repo is 3/4. While you have repo at 4%, the operational rate today is 3/4 because that's where Reserve Bank is absorbing liquidity from the banking system. We are a very large surplus situation today. The banks are parking about 7.5 to 8 lakh crores of liquidity daily with RBI. And that liquidity is getting absorbed by Reserve Bank at 3/4. So I would say that at the least or at the max, the market's operational overnight rate is 3/4 and not weighted average call money rate. There's a very limited amount of money that gets transacted at call money, in call money, and that sort of happens to be at a higher rate. But real operational rate is 3/4 in that sense. And if you look at the true market rate, where all the other participants, including banks and mutual funds, are participating, that's close to 2.5. So I would argue that the spread is fairly high in that sense.
Okay, sorry, I must apologize. It completely slipped my mind. I don't know why I said 440 on the repo. I guess I forgot about the last round of rate cuts. Apologies for that. Okay,
it's happening so
you're
fast
saying that
that
RBI intervention.
I'm saying it's happening so fast that it's difficult to keep pace with it.
I know. I'm sorry about that. But so you think RBI intervention is needed firstly to bring down that term premium? And I'll come to the credit spreads part first. But would you say that if OMOs, etc., come sooner rather than later, some of that would get addressed?
So it can be a combination of interventions. One is a direct intervention by Reserve Bank in the form of OMOs, where they start buying longer dated bonds, either in primary or a secondary market in their own balance sheet. Second, the intervention could take the form of a switch auction where they start supplying, short dated bonds to the market and start buying the longer dated bond, which is a sort of operation twist in that sense, because the market has a lot of liquidity right now. The shorter term bonds, the bonds going up to 1 year, the treasury bills are all trading at very, very tight ranges compared to the overnight. I mean, some of them are actually trading below the reverse repo rate. So if you supply more and more paper at that point, probably the short end rates will go up by 10-15 basis points, but they'd still be within the realm of where the overnight is. And it could help, and buying out of the longer dated bonds would help the longer end of the yield. So you'll flatten out the yield curve. That's the second kind of intervention that can happen. And the third kind of intervention is to allow banks, means to take more risk on the balance sheet. Currently, the reality is that most of the banks are actually full up on their HTM limits, and they would. And they're kind of hesitant to buy bonds in their books, especially the longer duration bonds, because you are adding on to the market risk on the balance sheet. But if banks are allowed to buy more of these bonds in the HTM portfolios where they don't have to mark to market, the banking sector's risk appetite to buy these longer dated bonds will increase, and that could actually also help in pulling the yields down. So it could be a combination of each of these things, but yes, some intervention would result in the yields coming down at the longer end of the curve and the curve becoming more flatter.
Powder dry for later in the year? Because these are things now for months folks in your community have talked about and suggested. Why are they holding off?
I think they are. I think all of us are in a very uncertain time. Let's give it to them that number one, as a central bank, as a policy maker, they have been very proactive, right? They have done 3 rounds of massive interventions in the market. They have cut the rate significantly. They have provided, you know, tons of liquidity to the market, much more than what was probably required to make sure that liquidity doesn't become an issue. So I think all the intervention in the first stage has been in terms of addressing the fact that one, the monetary policy actions that are required to be taken given the current situation are being taken. B, the market has the confidence that Reserve Bank is acting proactively, and that's a huge thing in today's environment. Some of the actions, I guess, are kept for a slightly later point in time, because as time passes, as economy opens up, you will probably have a better clarity on what is the size of fiscal impact that you're talking about, and what is the size of intervention that is required. And hopefully by then, once the situation becomes clearer, then Reserve Bank can also time and size the amount of intervention it needs to do. So that's my personal guess. I don't know why they would not want to do it right away, but my guess is that you need to sequence some of these things, and it is a very evolving situation. Nobody knows exactly how much is the impact on the economy. So I think as the situation evolves, as it becomes clearer, maybe some of these interventions will become the estimation of the size of these interventions will become a lot more easier.
Okay. Neeraj, what are conditions like in the non-government financing market? I mean, sort of corporate finance flowing through bond markets, etc. Did the LTROs do what they were intended to do, but yet have only solved part of the problem in a very select set of high-rated companies?
I think the activity on the corporate bond side has been very good and very strong over the last 2 months. If I look at the various markets and what has been happening to these markets since the time lockdowns were announced somewhere in the last week of March, I think the corporate bond market has been the most active. Clearly, there has been a lot of activity in the government bond market as well, whereas the client activity on the foreign exchange market has come down quite significantly, I think by about 30-40%, because of the fact that our trade is quite restricted right now, and most of the clients are operating from home, etc., etc. But coming back to corporate bond market, I think there is a very strong action that is happening there, both in the primary and the secondary market. A lot of that is driven by the fact that banks took approximately 1 trillion INR in the form of TLTROs, and that money was to be invested, and that money has been invested over a period of time. And as a result of this investment, both in primary as well as secondary, we have seen a considerable amount of activity on the primary issuance side and a considerable amount of activity in the secondary market trading side. We've also seen a good amount of liquidity sitting out there, which is finding its way into short-term assets. So if you, for example, start looking at what's happening to the CP and CD rates, up to 1 year, they've also come off quite sharply. CP rates have actually gone below 4%. So For those issuers which have strong balance sheet, they have good credit rating, access to funding through corporate bond market, I don't think is a big issue right now. Even the pricing is not that big a issue. I think the challenge that we have is that this liquidity and this funding is only available to a select set of clients, a select set of corporates, those who have strong balance sheets, strong pedigree, strong, strong recognition in the market. The percolation of this liquidity down to, let's say, a single A rated company, or let's say lesser rated companies, is still not there. I think those entities still are dependent upon bank financing, and corporate bond market to them in some senses is shut, as is the case for the tier 2 NBFCs. So those issues are essentially credit risk issues. I think this is something that cannot be addressed by either TLTROs or by RBI providing a lot of liquidity. I think that's something that will evolve and probably be addressed as the economy opens up and economic activity comes back, and people start getting more confidence on these balance sheet and their ability to service the debt. So I think that's the key issue there. I don't think the central bank interventions uh, can provide the kind of comfort that is required for people to take this kind of credit risk.
What would be your view on this chatter that the RBI should start doing repo against corporate bonds? I don't understand it in the current context, because even if they were to do that, I assume they would only pick the AAA credits, and the AAA credits is not where the problem is right now. So while a lot of people seem to be suggesting that as one move, do you see the need for it?
I think it was probably more relevant at the time when TLTROs were not done. I think at that point in time, I think probably central bank had the option of either opening its own balance sheet to corporate credit risk or doing it through the banking system. I would say that TLTROs have been quite successful in the Indian context in the current environment, right? And they've achieved what was the key objective, which is basically providing liquidity to the corporate bond market. Even if you're right, I mean, even if Reserve Bank was to open up its own balance sheet for corporate credit risk, I don't think they will do it across the board. I think they'll probably limit it to AAA, maybe PSU names. So, eventually the benefit will first flow to those issuers who are considered to be highly creditworthy by the markets, those who have access to the liquidity, but probably that access was at a very high price. And what the TLTROs have ended up doing is actually make that price much better, tighten up the spreads for these names, and provide some liquidity to these names. I think that's a good starting point, and what TLTRO has achieved. We must also be mindful of the fact that, yes, as market participants, we've been asking for Reserve Bank opening up its balance sheet for corporate bonds and allowing corporate bond repos. The reality is that very few central banks, even in G20, do that. And those central banks that do that, they do it for a very short term. So I think it's still a bit of uncharted territory for central banks to actually buy outright corporate credit risk, especially the longer dated credit risk in their own books. I think the preference continues to be to have sovereign or quasi-sovereign risk in the balance sheet.
Neeraj, a word on the liquidity situation, actually a two-part question. One, the fact that this surplus, very heavy surplus liquidity is continued, and it's leading to some of the things that you were talking about earlier, rates in the TREPS markets being well below reverse repo, some of the PSU names having raised CPs, or at least in the secondary market, CPs trading close to or below reverse repo. Do you see this as distortion of monetary policy? And if so, do you think the RBI at some point or the other will need to start worrying about whether this surplus liquidity should be allowed to stay in the market or not?
I think, first of all, I don't think that's a distortion. I think this is exactly what the policy intended, which is why you had a massive round of rate cuts, which is why you had central bank doing all the liquidity interventions that it did, including a reduction in the CRR. Remember, the reduction in the CRR rate from 4% to 3% is not a normal phenomenon in the Indian markets. I think in the last 25 years of our history, we would have seen barely 3 or 4 instances where Reserve Bank has chosen to cut the CRR. So it's a fairly important and well-intended intervention that the central bank has done to provide a humongous amount of liquidity to the system, to make sure that the rates are low, so that whatever benefit that the economy can get in the current circumstances of these policies, it should get. Uh, I mean, at some point in time in future, do we need to reverse some of these actions? Probably yes, but that will be highly contingent upon how fast the economic activity comes back into normalcy. What is the impact? When do we feel that the growth has reached a stage where this level of stimulus is not required? Sometimes it's very difficult to judge those circumstances a priori, and you need to wait for the data to flow through to say that yes, indeed, we've reached a stage where the stimulus can be drawn. I don't see that point of the point of return or point of sort of inflection to be very close. I would think that at least 6 to 9 months we will need this kind of liquidity to stay around in the system, and we will need these kind of rates to stick around in the system, because the impact that the current lockdown has had, we've had almost 2 months of lockdown now, 2 months of almost negligible economic activity, and there has been a lot of structural impact on the economy. So impact of all these can be fairly long drawn, and it can take quite a bit of a time for economy to come back to normalcy. So we will need this stimulus to stay around for that time. And I think in the current context, the growth numbers will be far more relevant than the inflation, because inflation data can continue to show a 4%, 5% handle inflation rate, but the reality is that we are in a negative growth zone currently, and we will continue to be in a negative growth zone for some time. And for the year as a whole, will be a negative growth, right? So we need to continue to have this stimulus stay around for a long period of time.
So at most, the RBI would need to introduce an SDF or something. But again, they seem to be dithering on that for some reason. Maybe it's not required immediately, but eventually it will be needed if this liquidity position continues.
See, SDF, the logic and the rationale for SDF came into play when there was a fear that the total amount of government bonds that Reserve Bank has will prove to be insufficient to be able to do the overnight or other, the reverse repo operations that they need to do to manage the liquidity in the system. I don't think we are at that stage right now. But if we do reach that stage, if the liquidity in the system continues to add because of their various actions, then probably at some point in time SDF may need to be triggered. But I think at this point in time, whether it is an SDF or whether it's a reverse repo, I think the impact is the same. The rate at which the central bank is withdrawing liquidity from the system and absorbing liquidity from the system, 3.25, that is, the market is actually trading well below that rate. So I think it's just a theoretical discussion right now.
Okay. Just two more questions, Neeraj. One, circling back to sort of Moody's and the fiscal position. What is the market's thinking on the government's fiscal position? That 12 lakh crore is sort of a line in the sand, that they may not need to borrow more than that? Or is it still, sort of worried about the possibility that that number would go even higher this year?
I think we are all, we are all playing a little bit blind here, because nobody has as much clue about what is going to be the receipt side and what is going to be the expenditure side of the government's balance sheet. Particularly on the receipt side, what is the kind of the tax revenue shortfalls and indirect tax shortfalls that we will see for the full year? Like I said, we've just finished 2 months of the year. We still have a full 10-month period to go by, and situations can change quite dramatically. So it's very difficult to sort of take a very definitive call on this. Um, it does feel like that we will have a significant fiscal slippage this year. Whether the number that they have thrown out to the market at this point in time, which is 4 lakh crore of additional borrowing, whether that's sufficient, I don't know. I don't think anybody can say that with any amount of certainty. I'm not sure if the government itself knows about it with any amount of certainty. But the reality is that whatever that number is, whatever that fiscal deficit number is, there are 2 or 3 alternative ways in which that can be funded, and one of them is market borrowing. So it's possible that they might actually choose to keep the market borrowing size what they have announced at this point in time and modulate the other pieces. For example, they could do a lot more on the short term. They could keep the WMA drawdown. They could also sort of tweak the amount of funding that they take from small savings schemes, etc. So there are these options that are available.
Or direct monetization, Neeraj, you didn't mention that.
Well, I see, the thing is that eventually the market believes that central bank will support the government's borrowing program. Whether that support comes in the form of a primary market direct monetization, or by way of purchase in the secondary market, or by way of some kind of operation twist, remains to be seen. I think the net, your question was that will the government end up borrowing more than what they have indicated? What I'm basically trying to say is that the the dated securities borrowing program, the calendar that they announced of additional 4 lakh crores, it's possible that they may sort of keep it there while they modulate the other components of the borrowings that they do.
Okay, understood. Neeraj, the last word on sort of both the foreign investor interest in Indian government bonds, which has been quite weak. I think we are below 50% in terms of limits being utilized, even though some money has started to flow back through to markets like Indonesia, etc. But they seem to be staying away from us. But despite that, I guess one good thing is that we haven't seen much sharp volatility on the currency side, so that's good news. But the foreign interest in Indian domestic debt seems quite muted.
It will be because as we started this discussion by saying what rating agencies will do, uh, the threshold of investment grade is very important threshold. As you get very close to that threshold and as the outlook start becoming negative there, it's quite expected that the foreign investor interest will be somewhat muted. But if through the year we actually come back into a situation where we see that the economic activity is back, the growth is back, the inflation is managed, and there is probably not that much of a need of further stimulus, and hence the market starts believing that the actual downgrade may not happen, I think that's the point in time we'll see more investor interest. You're right in saying that the currency has been fairly stable. But one of the reasons why currency has been fairly stable is that in the the way the structure of our economy is that if the growth subsides quite sharply, our current account also compresses. So our current account has actually compressed. We would be probably pretty low in terms of current account deficit, and this is something that plays to the strength. So it's kind of an automatic stabilizer that we have. So given that fact, and given the fact that we have seen some kind of a tapering off of selling by the FPIs over the last month or so, I think that has provided this support to the currency. All in all, I would say that the yields in India continue to remain quite attractive. Across the world, we've seen massive rate cuts. Across the world, we've seen huge amount of stimulus being given by the monetary authorities. So clearly, the differential is in our favor. However, the issue currently is that whether we will see a rating downgrade below investment grade, and once that probability sort of starts reducing, you will see investor interest coming back into the market.
All right, Neeraj, we'll leave it at that. Thank you so much. Appreciate you taking the time
Pleasure.
to share your views on all things debt markets, currency, and of course the Moody's trigger, which has finally been pulled. Thanks for watching Bloomberg.
Pleasure. Nice talking to you.